Right now, in 2026, something has quietly happened to the state pension that almost nobody has explained properly. And I want to show it to you today, because if you have any savings sitting in an ordinary bank account, this affects you more than you think. Here's the number. The full new state pension for the 2026-27 tax year is £241.30 a week. That works out to £12,547.60 a year. Now here's the number sitting right next to it. Your tax-free personal allowance, the amount of income you can receive before HMRC takes a single penny, is £12,570 a year. It has been frozen at that level since 2021, and the government has confirmed it stays frozen until April 2028. Look at the gap between those two numbers. £12,507 minus £12,547.60. That's a gap of just £23. £23. That is the entire buffer between your state pension and the tax-free threshold for anyone receiving the full new rate. And because of the triple lock, the state pension keeps rising every single April. The personal allowance does not move at all, which means, for many retirees, the state pension on its own is about to eat almost the entire tax-free allowance, leaving virtually no room for anything else, including the interest sitting quietly in your savings account. Before I go further, if this is the first time you've actually seen these two numbers next to each other, hit like on this video right now. Not because I need the algorithm to like me, because the next few minutes are going to walk you through a calculation your bank will never do for you, and I want more retirees to see it before the end of this tax year. Subscribe to Retired UK while you're at it, because this channel exists specifically to explain the parts of retirement finance that nobody sends you a letter about. So let's talk about what actually happens when your savings interest lands on top of an almost full personal allowance. Here's how it works, step by step, and I'm going to keep this as simple as I can. Every basic rate taxpayer gets something called the Personal Savings Allowance. For 2026/27, if you're a basic rate taxpayer, you can earn £1,000 of savings interest completely tax-free on top of your personal allowance. If you're a higher rate taxpayer, that drops to £500. If you're an additional rate taxpayer, income over £125,140, you get nothing at all. There's also a second, lesser-known allowance called the starting rate for savings. This one is specifically aimed at people with lower incomes, which includes a lot of retirees. If your non-savings income, your pension income, essentially, is below the £12,570 personal allowance, you can get up to an extra £5,000 of savings interest, taxed at 0%. But here's the catch, and this is the part almost nobody explains properly, that £5,000 starting rate band shrinks pound for pound as your non-savings income rises above the personal allowance, and it disappears completely once your non-savings income reaches £17,570. Now put that together with what we just worked out about the state pension. If your only income is the full new state pension, £12,547.60, you are just below the £12,570 personal allowance, so technically you still qualify for close to the full £5,000 starting rate band, plus the £1,000 personal savings allowance. That's genuinely good news, and I want to be honest with you about that. On the state pension alone, most people still have a healthy amount of headroom for savings interest. But almost nobody retires on the state pension alone, and this is where it changes fast. Let me walk you through an example. I want to be upfront that this is an illustrative example, not a real client, just to make the maths concrete. Picture a retiree. Let's call him Graham. Graham is 68. He gets the full new state pension, £12,547.60 a year. He also has a small workplace pension, paying him £6,000 a year. That's £18,547.60 of what HMRC calls non-savings income. Straight away, notice something. Graham's non-savings income is already above £17,570. That means his starting rate for savings band, that generous extra £5,000 at 0%, has completely disappeared. It's gone entirely once you cross £17,570 of non-savings income. Graham doesn't get any of it. What Graham does still have is his personal savings allowance, because his total income of £18,547.60 keeps him a basic rate taxpayer. Well under the £50,270 higher rate threshold, he gets the standard £1,000 tax-free savings interest allowance. Now let's say Graham has £40,000 sitting in an easy access savings account, earning 4.2%, a realistic rate in the current environment. That's £1,680 of interest a year. Subtract his £1,000 personal savings allowance, and £680 of that interest is now taxable at his marginal rate, 20% basic rate. That's £136 a year in tax on his savings interest. Not a catastrophe, but it's £136 he wasn't expecting, and it lands automatically, usually through an adjustment to his tax code the following year, or through a simple assessment letter from HMRC if he's not in pay. Here's the part that actually matters though. Watch what happens if Graham has £100,000 in that same account instead of £40,000, still at 4.2%. That's £4,200 of interest. Subtract the £1,000 allowance, and £3,200 is now taxable at 20%. That's £640 a year, every year, for as long as that money sits there earning interest at that level. And because his pension income already used up the starting rate band completely, there is no second buffer left to absorb any of it. Every pound of interest above £1,000 is exposed. This is the mechanism. It isn't a scandal, and it isn't a secret new rule someone is trying to hide from you. It's simply what happens when a frozen personal allowance, a triple-locked state pension that keeps climbing every April, and ordinary savings interest all land in the same tax year at the same time. The thresholds haven't moved since 2021. Interest rates have moved a great deal since then. That mismatch is the whole story. And here's why almost nobody sees it coming. Your bank pays your interest gross, with no tax taken off at source. That's been the case since 2016. Your bank also reports what it's paid you to HMRC automatically, every year, without you doing anything. HMRC then works out whether you owe anything, and if you do, it usually adjusts your tax code for the following year. So a chunk of extra tax gets quietly deducted from your pension income without a specific bill ever landing on your doormat with an explanation attached. Or, if you're not on pay at all, HMRC can send what's called a simple assessment, a letter that just states the amount owed. Either way, the number appears with very little context. Nobody sends you the version of the letter that says, "Here is exactly why this happened, and here is what it will cost you every year going forward if nothing changes." So how do you work out your own number? Here's the framework, and I want you to actually pause and do this with your own figures, because it takes about 5 minutes. Step 1. Add up your non-savings income for the year. State pension, any workplace or private pension in payment, any part-time work, any rental income. This is your non-savings income figure. Step 2. Check where that figure sits. If it's below £12,570, you likely still have access to most or all of the £5,000 starting rate for savings, on top of your personal savings allowance, meaning a large amount of interest can stay tax-free. If it's between £12,570 and £17,570, your starting rate band is shrinking, pound for pound, as your income rises through that range. If it's above £17,570, your starting rate band is gone, and you're relying on the personal savings allowance alone. Step 3. Confirm which personal savings allowance applies to you. £1,000. If your total income, including interest, keeps you a basic rate taxpayer under £50,270, £500 if it pushes you into the higher rate band. 0 if your total income crosses £125,140. Step 4. Take your current savings balance sitting outside an ISA, multiply it by your interest rate, and see where that lands against the allowance you actually qualify for. Anything above your allowance is taxed at your marginal rate, 20, 40, or 45%, depending on your band. That calculation gives you a genuinely useful number, roughly how much you can hold in an ordinary taxable savings account before every additional pound of interest starts being taxed. Now, the part where we talk about what to actually do with the money that's sitting above that line. And I want to be honest with you here, this isn't about panic moving your money out of savings. Cash is still one of the safest places for money you might need in the short term. This is about being deliberate with where that cash sits. Option 1, and by far the simplest, the ISA allowance. Every UK adult gets a £20,000 ISA allowance for the 2026/27 tax year. Interest earned inside a cash ISA is completely tax-free, permanently, and it doesn't count toward your personal savings allowance or your starting rate band at all. It doesn't even need to go on a tax return. If you've got savings sitting in an ordinary account earning taxable interest, and you haven't used your ISA allowance this year, that's the first and easiest move. No reduction in security, no change in access for most easy access cash ISAs, just a change in the tax treatment. Option 2. NS&I premium bonds. Prizes from premium bonds are entirely tax-free and don't count as savings income at all. They're not a guaranteed return. Some years you win more, some years less, and the expected return floats with the prize fund rate. But for money you want to keep completely outside the tax calculation, they're a legitimate option worth understanding properly rather than dismissing as a gimmick. Option 3. Spreading between spouses. If you're married or in a civil partnership and one of you has significant unused personal allowance or a lower marginal rate than the other, moving savings into the name of the lower taxed spouse or holding it jointly can meaningfully increase the combined amount of interest that stays inside both of your allowances rather than concentrating it all against one person's threshold. Option 4. Pension contributions. If you're still able to make them. If you have earned income and haven't fully drawn down your pension, contributing to a pension can bring your taxable income back down, which in some cases can pull you back under the £50,270 higher rate threshold and restore the full £1,000 personal savings allowance rather than the reduced £500 one. Option 5. Gilts. Interest from UK government bonds is taxable in the same way as savings interest, but any capital gain on gilts is completely exempt from capital gains tax, which makes certain gilt strategies worth a look for retirees holding larger sums, particularly around managing income timing across tax years. None of these 5 options are exotic. None of them require restructuring your entire retirement. They require you to actually run the calculation I just walked you through, see where your number sits, and make 1 or 2 deliberate decisions before the end of this tax year, which runs to the 5th of April 2027. I want to be completely straight with you about something, because I think it matters more than the maths itself. This isn't a hidden trap set by a bank, and it isn't a new rule anyone slipped past you. The mechanism is exactly what it's always been. The Personal Savings Allowance has existed since 2016. The starting rate for savings has existed even longer, and the Personal Allowance freeze has been public policy since 2021. What's changed is simply that interest rates rose, the state pension kept climbing under the triple lock, and the tax-free thresholds didn't move an inch. That combination is what's quietly pulling more ordinary retirees over these lines every single year, without a single letter or headline announcing it's happening to them personally. That's exactly why it's worth 5 minutes of your time to run your own numbers, rather than assume your bank, your pension provider, or HMRC is going to flag it for you in advance. They're not going to. The tax code adjustment simply appears the following year, already calculated, already deducted, with no invitation to check whether it was optimal. So here's what I'd like you to do this week. Get your state pension figure, your other pension income, and your current savings balance and interest rate in front of you. Run the 4 steps I walked through. Work out your own personal savings allowance and whether any of the starting rate band is still available to you. And if the answer surprises you, that's exactly the moment to have a proper conversation with a fee-based, FCA-regulated financial advisor or a chartered accountant. Before the tax year closes, not after the letter from HMRC arrives. If this was useful, please share it with someone you know who's retired and keeps a large amount sitting in an ordinary savings account. Not because they've done anything wrong, but because this is one of those things that's genuinely worth 20 minutes of checking, rather than assuming it's fine. Subscribe to Retired UK for more of these breakdowns, where we go through exactly how the numbers work, with real thresholds, real allowances, and no scare stories. Just the maths that actually applies to your situation. Thanks for watching. Go and run your own numbers this week, and I'll see you in the next one.